Everyone is watching the petrodollar collapse. They are watching the wrong thing. For 63 days, the Strait of Hormuz has been effectively shut. Brent crude has traded as high as $120 a barrel and is still hovering above $108. Marine war insurance for Gulf transits has surged more than 1,000% since February. Saudi Arabia is pumping 7 million barrels per day through a pipeline it spent decades building for exactly this scenario. And every major de-dollarization channel on the internet is telling you the same thing, that the dollar's grip on global oil is finally breaking. Here's the part nobody's talking about. On April 30th, with all of that happening at once, the US dollar index closed at 98.08. It is up on the year. It has been the strongest currency in the developed world for most of the last 60 days. The euro is sliding. The yen required direct intervention from Tokyo, and the Chinese yuan, the supposed petrodollar replacement, is being managed inside a tighter daily band by the People's Bank of China. The petrodollar just took its biggest real-world stress test in 50 years, and the dollar held. That is the story. Not whether the system is breaking, but why it didn't break, and what the resilience is actually telling us. If you own a home in the United States, if you fill up a tank of gas, if you hold $1 of savings, this matters. Because the answer determines whether the next decade looks like a slow drift away from dollar dominance, or whether the dollar's monopoly on global commodity settlement is more entrenched than almost anyone is willing to admit. We are going to walk through the event itself, the only historical parallel that matters, and the implication that follows. By the end, you will see why this particular crisis has produced the opposite of the result so many people predicted. Let's start with what actually happened. On February 28, 2026, after a coordinated U.S. and Israeli strike campaign against Iranian targets, Tehran's response was the one Pentagon planners had war-gamed for 2 decades. Iran moved to close the Strait of Hormuz. According to the UK House of Commons Library briefing published in April, mining operations and missile boat patrols rendered commercial shipping through the strait essentially impossible. The U.S. Navy has stated publicly that clearing the mines alone could take 6 months. Al Jazeera reported on April 28 that this 6-month estimate is now the working assumption among shipping insurers and Gulf governments. To understand why this matters, picture the global oil map. Roughly 20% of the world's daily oil consumption flows through that 121-mile choke point. Saudi Arabia, the UAE, Kuwait, Qatar, Iraq, every Gulf producer except those with overland alternatives depends on Hormuz to reach buyers in Asia, Europe, and the United States. When Hormuz closes, the world doesn't run out of oil overnight. But the price of every barrel that reaches market goes up because the marginal barrel suddenly requires either a longer route, a pipeline alternative, or a willingness to pay war risk insurance that has, in some cases, increased by a factor of 10. Brent crude responded predictably. Reuters reported on April 26 that Brent settled at $108.23 after a 2.8% gain, having earlier in the conflict pushed past $111 and, at peak, near $120 according to CNBC's April 21st timeline. Investing.com noted that even at $108, Brent was up roughly 43% from its one-year low, and CNBC put the peak gain at more than 55% since the war began. The range matters less than the direction. Oil is meaningfully more expensive than it was 3 months ago, and that price is showing up everywhere. In the United States, 888 reported the national average gasoline price at $3.95 per gallon as of late April, with regional spreads from $3.30 in the central states to over $5.90 in California. That is up sharply from the $3.48 to $3.59 range in the early days of the war. In Europe, the impact has been more severe. Reuters reported on April 30th that Eurozone inflation jumped to 3.0% in April, up from 2.6% in March. And the European Central Bank held rates steady the same day, specifically because the oil shock has reintroduced stagflation risk. The ECB now has a problem the Fed doesn't quite have yet: inflation accelerating while growth slows. Now here is where the conventional petrodollar collapse narrative starts to get repeated everywhere. The argument goes like this: Iran is selling oil to China outside the dollar system. Saudi Arabia is talking openly about yuan settlement. The Gulf states are diversifying. Therefore, the crisis is accelerating de-dollarization, and the dollar's days as the world's commodity settlement currency are numbered. It's a clean story. It's also incomplete in ways that matter. Stay with me, because the next piece is where the picture changes. The data on China's yuan-settled Iranian oil trade is real. According to a U.S.-China Economic and Security Review Commission fact sheet from March, China buys roughly 90% of Iran's exported oil. And Reuters reported on April 29th that Chinese teapot refiners imported a record 1.8 million barrels per day of Iranian crude in March, A growing share of that flow is being settled in yuan, particularly through informal banking channels designed to evade U.S. sanctions. The Japan Times described this on April 14th as Xi's Petro-yuan dream getting new life from the Iran war. But look at the numbers behind the numbers. Iran's 1.8 million barrels per day is significant for Iran. It is not significant for the global oil market. Total global oil consumption runs around 102 million barrels per day. The Iran to China yuan-settled trade is, even at its peak, less than 2% of that total. And it operates because both sides have a specific reason to bypass the dollar system. Iran, because it is sanctioned. China, because it gets a discount of as much as 15 to 20% on Iranian crude relative to Brent. That is not a new monetary architecture. That is a sanctions workaround. There is a meaningful difference between 2.5 cents of every dollar of global oil trading outside the dollar system because both parties are penalized for using it, and a structural shift in how the world prices and settles commodities. Meanwhile, look at what the rest of the Gulf is doing. Saudi Arabia, when faced with the closure of its primary export route, did not pivot to yuan settlement. It did not announce a petro-yuan deal. According to Reuters, on March 28th, the kingdom redirected its crude through the east-west Petroline pipeline, running it at full capacity of 7 million barrels per day to reach the Red Sea. That oil, sold predominantly in dollars to European, Asian, and American buyers, has actually expanded Saudi market share during the crisis. Bloomberg reported on May 1st that the kingdom is gaining a revenue edge over Gulf neighbors precisely because its overland route to non-Hormuz tankers has remained intact. The Saudi response to a once-in-a-generation petrodollar stress test was not to abandon the dollar. It was to physically reroute the oil while keeping the settlement currency identical. That single fact has more analytical weight than 100 headlines about petroleum deals. And this brings us to Act 2, the only historical parallel that actually matters, and the one most analysts have wrong. Here is the standard version of the story you will hear on most channels. In 1973, the Arab members of OPEC imposed an oil embargo against the United States and several allies in response to American support for Israel during the Yom Kippur War. The price of oil quadrupled. The U.S. economy entered stagflation. And then, in 1974, Henry Kissinger flew to Riyadh and made a deal. Saudi oil priced exclusively in U.S. dollars in exchange for American security guarantees. The petrodollar was born from a crisis. The implication in the standard telling is that another crisis can break it. That is mostly wrong, and the part that is wrong is the part that determines what happens next. Read the Office of the Historian's official record on the 1973 embargo, and you will find a more interesting sequence. The petrodollar arrangement was not an emergency response to the embargo. It was the product of a much longer recognition, a recognition that began before the embargo and accelerated after it, that no other currency on earth had the depth, the legal infrastructure, the military backing, or the financial plumbing to function as the global oil settlement currency. The dollar wasn't chosen because Kissinger out-negotiated the Saudis. The dollar was chosen because the alternatives didn't exist. The Soviet ruble was non-convertible. The German mark and Japanese yen were too small. The British pound had already lost its reserve crown. Gold was fixed in supply and politically controlled. Fast forward to 2026. What are the alternatives now? The euro, with the ECB struggling against stagflation and the eurozone bond market still fragmented across 19 sovereign issuers. The yen, which required direct currency intervention on April 30th to stop a slide. The yuan, with capital controls, a managed float, and an explicit Chinese policy of keeping its currency from being too internationalized because that would surrender domestic monetary control. Gold, which the World Gold Council reported central banks bought 244 tons of in Q1 2026, but which still represents under 18% of global reserves even after a 5-year accumulation cycle. Here's the uncomfortable observation. Every serious alternative to the dollar in 2026 has the same problem the alternatives had in 1974. Either insufficient market depth or insufficient legal trust, or both. 60 days into the worst commodity system stress test in half a century, the world is not running into a different settlement architecture because there isn't one ready to absorb the volume. This is why the Treasury's quiet diplomacy this month is more revealing than any of the dramatic headlines. On April 24th, Treasury Secretary Scott Bessent told U.S. lawmakers that the agency is in active discussions with Gulf and Asian partners about extending permanent dollar swap lines. His framing was specific. He described it as creating new dollar funding centers in the Gulf and Asia. On April 30th, in his remarks before the XIM annual conference, he doubled down on the dollar's central role in enabling U.S. economic security. To be fair to the alternative view, the swap line outreach has been read by some critics as a sign of weakness, an acknowledgement that the dollar system needs reinforcement. That is a defensible reading, and it deserves to be on the table. But the more probable interpretation, given the timing during a Gulf crisis, is that the United States is using the moment to deepen the dollar's institutional reach into precisely the regions that competitors hope to peel off. Let's pause here. We have moved from the immediate event to the historical parallel. The remaining question is what happens next and what it means for the viewer who is filling up a tank, paying a mortgage, or watching their savings. This is the Implication Act, and it is the part the de-dollarization narrative gets most badly wrong. The first implication is on inflation and rates. The 10-year Treasury yield closed at 4.40% on April 30th, near the year's high, after the Federal Reserve held rates steady at the April 29th FOMC meeting. The yield is rising not because the dollar is weak. It is rising because the oil shock is feeding into U.S. inflation expectations, and the Fed has signaled it cannot cut while energy prices are this disruptive. For American homebuyers, this is the part that hurts. Mortgage rates track the 10-year. Every basis point higher in the 10-year is roughly a basis point higher on a 30-year fixed mortgage. The Hormuz crisis is, in effect, a tax on every American household that is trying to buy a home in 2026, and that tax is being collected through the bond market. The second implication is on the fiscal trajectory. The U.S. is now running an interest expense of approximately $88 billion per month, on track for over $1 trillion annualized, on a national debt that has crossed $39 trillion. Every 0.25% the 10-year stays elevated because of an oil-driven inflation premium adds roughly $97 billion in additional interest costs to the federal government over the next year as debt rolls over. The petrodollar's resilience is, in this sense, a double-edged sword. The dollar holds, but the cost of holding it falls on U.S. taxpayers in the form of higher debt service. The third implication, and the most important one, is about reserve composition. The World Gold Council reported on April 30th that central banks bought 244 tons of gold in Q1 2026, the fastest pace in over a year. The LBMA quarterly average gold price set a new record at $4,173 per ounce. BRICS Plus countries now hold 17.4% of global gold reserves, up from 11.2% in 2019, according to Mining Weekly's April 7th reporting. Read those numbers carefully. Sovereign buyers are not abandoning the dollar. They are diversifying around it, and that distinction is the entire game. The dollar's share of global reserves has drifted from around 72% 2 decades ago to roughly 58% today. That is a real shift. It is also a slow one. At the current pace, the dollar will still be the dominant reserve currency a decade from now, just less dominant. The Hormuz crisis has not accelerated that drift. If anything, the safe haven flows during the worst weeks of the conflict reinforced the dollar's role precisely because no alternative could absorb the demand. Quick check before the synthesis. Remember the contrarian observation we opened with, that everyone is watching the petrodollar collapse, but the dollar held above 98 during the worst stress test in 50 years. That observation is not the conclusion, it is the data point. The conclusion is what the resilience tells us about the structure of the system itself. Here's what watchers are noting as the next thing to track. The Saudi-led OPEC Plus production decision in May, the Iranian government's willingness to negotiate or escalate further in the Strait, the Federal Reserve's June meeting and whether it acknowledges oil-driven inflation as transitory or persistent, the pace of central bank gold accumulation in Q2, and, quietly but importantly, whether any new bilateral oil settlement arrangement actually gets executed in a non-sanctioned currency at scale, not announced, executed, with volume that shows up in BIS data. If the Hormuz crisis ends with a negotiated reopening, the dollar's role will likely strengthen, not weaken, because the resolution will involve dollar-denominated reconstruction flows, dollar-denominated weapons sales, and dollar-denominated insurance recovery. If it ends with a permanent rerouting of Gulf flows through pipelines and the Red Sea, the dollar's role will also strengthen because those alternative routes are themselves financed in dollars and insured in dollars. Either path leads through the same currency. The petrodollar stress test is not ending in collapse, it is ending in entrenchment. And the irony of that outcome, after 50 years of analysts predicting the system would shatter at the first real test, is the kind of monetary observation history tends to remember. That entrenchment comes with costs that fall directly on American households through higher mortgage rates, higher gasoline prices, and a fiscal trajectory that gets harder to manage every year the 10-year yield stays elevated. But the dollar's monopoly on global commodity settlement is more durable, not less, in the world that emerges from this crisis. That is the signal. That is what the data this week is actually showing. If this breakdown helped you understand what the Hormuz crisis is really doing to the dollar system, the bell icon makes sure you catch the next one. We are tracking the May OPEC Plus decision and what it means for the Fed's June meeting. See you there.